if my house is burning, my attitude is I want to be protected. And the only way I can be protected is not by saying, well, I'm going to diversify, so if my house burns, I have a tent over there. That's called diversification. So my tent won't burn down, but then, I mean, if there's a forest fire, everything's, because I live in the mountains. So I've used insurance. So the bottom line is, during the COVID drawdown, let's talk about the portfolios. During the COVID drawdown, the market was down 34. The 60-40 was down 20. Our bear strategy was down 12.3, and the ARS, these two use insurance. Of course, these, well, that uses diversification. Now, when the market bounced, our ARS portfolio didn't bounce. And I got some calls, and I talked to my team, and it was very frustrating. And the first question when I got the calls, I said, well, the problem was when vol got crushed, when the market did start to bounce, our call options actually didn't make money because they lost as much money in vol as the market made a movement, because options are affected by both of those. So we were flat as the market's going up. However, the bear strategy didn't have that problem, yes, but it was down a little bit more. We were down 12.3 in our bear strategy. We're down 6.8 in the ARS strategy. But we didn't have the bounce problem that we had in the ARS portfolio. So I sat down with Pat and Amadi, and I said, okay, we got to be bouncing when the market's bouncing. Yes, we're hedging, but we got to bounce. If you look at the returns on the bear strategy, the blue line is the bear strategy, the red line is the market. Okay, so you can get an idea of, the downs and then the ups. You can see that we did bounce. Yes, we did drag a little bit, but we definitely did bounce as the market did bounce, where the ARS was flat. So what we really kind of looked at was, we liked the return. The return on the ARS was over 15.9 annualized, better than the ARS strategy. But we said, okay, is this drawdown acceptable? And can we shave something off this drawdown and shave something off this return to sort of blend the two? So what happened was, and these are our different strategies that we run at the firm, the bear strategy is very similar to the absolute return. The only difference between this strategy and this strategy is a slight difference. Same break system. This strategy owns calls for upside. This strategy actually owns the underlying asset. So this owns the ETF. This owns the SPY or the IVV. IVV and SPY are the same thing. The difference between the two is IVV charges 3 basis points a year. SPY charges 10. So it's the same thing. It's just you're buying the index of the S&P. This strategy owns calls on the S&P. Well, that's what happened. When you own calls on the S&P and the market bounced, our calls didn't make any money because the upside, in other words, the delta was canceled out by the vega. Okay, it's jargon, don't want to go jargon. But so what we did was we said, okay, let's do this. Let's move the bear strategy, which we did on November 13th, which was Friday the 13th. So I said, Pat, it's Friday the 13th. I said, I know. He says, well, I said, screw it. Because we looked at the numbers and we said, okay, so since November 13th, the strategy has had a change. And the change was, if anybody actually looks at their statement, you'll see in your statement, you'll see, instead of calls, you'll see something called IVV. I don't know if anybody's noticed that in here on your monthly statement. That's actually owning the spot. So we're up since that changed 12.30. The 60-40 is up 6.64. So a big difference in the two. The red line is the S&P 500. Because we own insurance, as the market continues goes down, we lose less and less. That's what insurance does. Okay. So what we did was, I told Pat and Monty, I said, let's do this. If the market is down between 2 and 3%, let's add a very inexpensive ancillary brake system. So the difference between the gray line and the blue line is a difference between what we did, because we said, listen, 12.5% might not be acceptable for a lot of my clients. that are invested with me. 6.8 was good, but they want to appreciate. So we said, well, let's use the bear strategy, but let's put a secondary hedge. So if we do get a real market decline, our losses are going to be a little bit less, but we're not going to hurt our upside. And the upside, you can see the blue line and the gray line, you could barely see the blue line. So you're not really giving up any upside. In fact, the math tells us this, that the cost of this ancillary hedge was about 3% over a 5-year period, or about 0.5% a year. The nice thing about that is when you own this spot, when you actually own the underlying asset, you're picking up the dividend. The dividend on the S&P right now is about 1.5%. So that's kind of nice, because if I'm adding an ancillary insurance hedge and it's costing me, but I'm picking up the dividend, it's sort of canceling out that. So the nice thing is now we get the dividend. You'll actually see that in your statement when Mallory sends you, or in your TD statement. You'll see when the dividend is paid on IVV, and you'll see it hit your account. That's a change that we made. The portfolios have been capturing a real nice part, because we own 90% of your portfolio is invested in the S&P 500. 90% of it. 10% of your portfolio is invested in our insurance policy, our hedge system, which is basically our put system. It's our break system. And so we're going to capture, because if it's 90 minus 10, because 10 is our hedge system, we're going to capture about between 70 and 80% of the upside. And that's what we've been capturing if you look at the market compared to us. But we should really cut off that left tail, because we own hard insurance. I think that's a really exciting change I wanted to talk about.